This covered call returned 10.8% in 22 days, which works out to about 179% annualized on the $5 capital base. Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. I took this trade because it combined two things I look for: a bullish long-term thesis and attractive premium income. I like the setup, I like the price point, I like the opportunity. Today I'm going to go over an actual covered call example. This is a covered call on a stock that I saw there could be very good potential with. This is an ETF based on MicroStrategy. I saw that there could be a heck of a nice ROC, return on capital, with this particular trade. Now, I bought this stock or this ETF back here around February, in late February, around $4.25 ish. I've been selling covered calls on it since, but I wanted to show you what I did recently with this, how I view this, and how we can make this a nice trade for you. So around March 26th, I sold 10 covered call positions against my 1,000 shares with a $5 strike. I thought this would be a nice place to get in at. The point of control, which is this red line, right around $5, was a point of support. I saw a turnaround coming with regards to Bitcoin, MicroStrategy, and I'm very bullish long term on this ETF and MicroStrategy and Bitcoin are as other assets. So I entered into 10 contracts here. This was on March 26th, again, 10 contracts, straight $5 strike. I received 54 cents premium, and the expiration was April 17th. So the total premium I received was $540. So the reason why I chose this $5 strike was, as again, I see support at that $5 level. Usually when I put on a covered call, I will go to the 0.2 delta. In this case, I went towards the closer to the at the money covered call because of the support that I saw and the overall bullish feeling I had on this on this company. I see that we are in the middle of the Bollinger Band. We had support on the 21-day and the point of control, and I felt this was definitely a good place to be adding a position here. So the trade actually in initial went against me. As you can see, I bought it here on March 26th. And by April 2nd, we were down to around $3.70 ish. And what I didn't do was panic. I didn't sell out of my position. I looked left and I saw that there was major support here from back in early February that I felt confident that we would bounce from. So I wasn't panicking. We're at a very nice support level. We're at the lower Bollinger Band, and I could see the RSI was a bit oversold, and there's relative volume was kind of staying stable. I didn't see any major selling off or anything like that. I felt confident being here. So I stayed calm, and my thesis for a long-term bullish behavior on this ETF was still intact. So the final outcome after a couple of very nice days on April 17th, which was Friday, we're recording this video on April 18th, but on April 17th, yesterday, the options that I bought expired worthless, meaning, or I'm sorry, the options I sold expired worthless. So as an option seller, you want your your options to expire worthless. That means that you won that trade, if you will. Now, that was 10.8% in about 22 days. You annualize that out, that's 179, 180% based on a $5 entry point. So this was a very good trade for me. My trade plan was to actually get out at 80% or so. But I went ahead and let that ride only because we were such a bullish behavior on that day, April 17th. What I want to show you too is when you get into trades like this, it's not that you have to have a winner or a loser. In this case, my trade plan was to purchase a covered call above my strike price or my cost basis, collect premium, and then get out of that trade when I was at 80% profit or more. And that trade plan worked perfectly. A little bit of downward moment here, but I wasn't scared again. And the trade worked out very well. But it also worked out for the buyer of this option. So I win because I got $540 in 22 days on a lower price, a lower priced ETF. The buyer who purchased these covered calls from me, they ended up winning because they bought the covered calls at $5. And the price is currently at 720 something, 728. And so the buyer wins. I win because my trade plan worked to a T. And I'm okay that the fact that the stock price ran up a little bit. Could I have got more? Yes. I could have made a little bit more money if I would have just bought the shares here and sold here. But seeing that my trade plan, I bought the shares back in here. My trade plan was to sell $5 covered calls and collect that $540 in 22 days. And that worked out perfectly. My trade wins, the buyer wins, and in options world, that's a win. So if you get anything from this video, hear this portion of it, just to know that you enter into the right thing with the right type of trade plan, you make your money and the buyers can also make their money and everybody's happy. So we'll move on to the rest of the video, but I wanted to show you this trade. Before I sell covered calls, I do want to keep a couple core rules in mind. I want a stock I'm bullish on long term. I want to strike above my cost basis. Never sell below your cost basis if you can help it. I want a fair premium for the risk. And I want to make a clear plan before I enter the trade. Where to enter, when to get out, and follow that trade plan. This trade reinforced a few important lessons for me personally. Have a bullish thesis, enter with a reason, stay calm during pullbacks, sell at a strike you're comfortable with, and when the trade works, be happy with the result. And that's how this trade ended up. Now, not all trades work out perfectly. Sometimes these positions do have to be managed a little bit. But if you have a trade plan and you work the trade plan to how you originally designed it, you're going to find out that selling covered calls in a safe way can give you very good results over time. This is also one of those things I like about this type of setup. A smaller account can scale into this with 1 or 2 contracts. A larger account can scale in with a lot more. The process stays the same, only the size changes. So whether your account is small or large, the principles stay the same. Good stock, good strike, good discipline, only the scale changes. So covered calls done right are not about chasing every dollar of premium. They're about having a plan, choosing the right stock, selecting the right strike, and being satisfied when the trade works. Over time, consistency matters more than squeezing every trade. If you enjoy practical income investing content like this, make sure you like and subscribe. I'll see you in the next video where we're going to break down another real-world strategy. Thanks for watching.